Genuinely, high-quality businesses don't often get less expensive. That's rather the point of them. So when one starts trading below what it has typically cost over the last decade, it is worth understanding why and whether anything has actually changed. The company is S&P Global. You've heard its name your whole investing life without necessarily knowing what it does. It owns the S&P 500 index itself, and every fund that tracks that index pays to use it. It also rates the debt of companies and governments, in a business where essentially two firms do most of the work. And you can see what kind of business that is in one chart. Gross margin, which is what is left of each sales dollar before overheads, has sat around 70% for a decade. Operating margin has run in the 40s. Businesses that charge for information, rather than for making things tend to look like this, and very few of them exist. It also nearly tripled in size over that stretch, from $5.3 billion of revenue in 2015 to $15.3 billion last year. Growing that much while holding 70% gross margins is a rare combination. There's one visible dent in 2023 when operating margin dropped to 32%, while it absorbed a very large acquisition. It has since recovered to 42%. Now the interesting bit. Our valuation read says fair value, and it's marked high reliability, which means this verdict has plenty of history behind it. At the close on the 19th of August, the shares were $426, sitting slightly below their own 200-day average. Here's the number that matters. It trades at about 25.5 times earnings, against a 10-year median of 32. That's meaningfully below its own normal. And the cash it generates relative to its price is running slightly better than usual too. On its own history, this is the less expensive end of the range. 15 of the investors we track hold it, and they aren't unanimous either. 6 added or opened new positions last quarter. 5 reduced. So this isn't a case of everybody piling in, and I would be suspicious if it were. What stands out is how large some of these positions are. Chris Hone of TC has almost 11% of his entire portfolio in this one company and held it steady. Pat Dorsey has 8% and added. Triple Frond, Christopher Bloomstrand, and John Armitage all opened brand new positions. Valley Forge, which had nearly 20% of its book here, trimmed. Big conviction on both sides. The honest risks are worth saying out loud. A large part of what it earns comes from rating new debt, and companies issue less debt when interest rates are high, so that revenue moves in cycles. Ratings agencies also attract regulatory attention from time to time, and a business this good rarely gets truly inexpensive, so patient buyers can wait a long while. So that's the picture. A business with 70% margins that nearly tripled in a decade, owning an index everybody uses, and half a ratings duopoly, currently priced below its own 10-year average, with serious investors holding very large positions in it and others taking money off the table. You now know what this company actually does, what it usually costs, what it costs today, and where the risks sit. That's enough to form your own view, which is the only one that will keep you calm when the price moves. The decision is yours to make. Visit us at smartcharts.co, where we explain the stock market in plain English for people who were never given the manual. Nothing here is financial advice.